Good morning, it's Peter Stimson here from Empowered Mortgages. It's Friday the 11th of April. Third video in 3 days, but we thought it was worth doing an update here given the markets are in chaos again and trying to provide a little bit of context as to what's going on. We hoped, or Donald Trump rather was hoping, that his relaxation of some of the tariffs in the last sort of day or so was going to calm things down. Unfortunately, it's not done so. It's not done so really for a couple of reasons. Firstly, tariffs are still there in large forms. We've obviously now got 145% on China, and China has today retaliated with 125% tariffs. We've obviously still got the 25% tariffs on steel, aluminium and cars, and obviously 10% across the board. We think the other reason is still the markets have discovered Donald Trump's equivalent of Superman's kryptonite. So not often that Donald Trump gets compared to Superman. There's probably not any other comparisons you could really make on that regard. But US Treasuries are obviously his big weakness. A third of US Treasuries are held by foreign governments, and the big holdings are by Japan, and you've guessed it, China. So, there's 39 trillion of US Treasuries out there in the market, and 9 trillion of these come up for renewal in 2025. So, if you're going to move the needle on price as a foreign government, all you need to do is either, not rebuy when these things come up for sale, or sell your existing stock into the market, and you can move the price quite considerably and cost the US government an awful lot of money. And that appears to be kind of why Donald Trump backed off on this. There's an old saying, and it's pretty wise, which is you can't buck the markets. And we think, the continued pressure on, Donald Trump, his policies from the markets, from the equity markets, from, what's going on in US bonds may well mean that, the tariffs in all sort of sense of forms get removed over the next few weeks. But, we'll see where this plays out. In terms of the UK, we've had GDP data this morning. So that was much more positive than expected. Up from 0.1% up to where it was planning to come out at, up to 0.5%. Normally what you'd get would be a kind of a big spike in swaps upwards. It's not really moved the needle given everything else that's going on. We've got a little kind of bit of a dead cat bounce this morning, and it's just dropped right back, as you'll see from the swap graph going up now. What does that mean? Well, it means we're still probably nailed on, or pretty much nailed on, for a cut in bank base rate on the 8th of May. Bear in mind, if we do get a cut, that's already been pretty much priced into the swap curves you're seeing. So, lenders pricing on fixed rate mortgages, it's already in there. So, if you're talking to clients about, mortgage pricing and stuff like that, don't expect swaps to keep sort of dropping when and if bank base rate gets reduced on the 8th of May. Final note, just on lenders' mortgage pricing, it is very difficult if you're a lender at the moment, and I know the very small violins are coming out at the moment on this price. If you're a lender trying to price and trying to get mortgage ranges out there at the moment, when you've got intraday movements of sort of 10, 15 basis points, and the curve, the swap curves are sort of doing that on that basis. So, there will be sort of, we think, more reductions coming from sort of the bigger lenders. It's just taking a little bit of time given everything that's going on. That's it from me. If anything changes or any more updates, we'll try and get some more pricing or some more updates out there. Thanks very much.